All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Again, we're closing out an eventful month, quarter, and first half of the year. Joining us now to make sense of it all is Scott Wren. He's a senior global equity strategist at the Wells Fargo Investment Institute. So, Scott, as you kind of look back on what we've seen so far or what we've seen during the second quarter, how are you making sense of the rally that we are going to, kind of codify here, right? This is one of the best second quarters that we've seen for the market really in history. And as you look at the situation right now, is there a way that actually makes some sense to you?
Well, Miles, I tell you, it has been a crazy quarter, and certainly our clients are asking us, how can we have such a major rally when all of the economic news is pretty bad? And so, the market's going to look ahead. Clearly, the market's anticipating that we see some GDP growth as we are in the third and fourth quarter, and then we're back to a modest pace of growth in 2021. But this has been a crazy quarter, and I will say one thing: when you shut the economy down, do you expect a big move down in the stock market? You do, but the magnitude of this rally coming back, and really, we're off the recent highs, but from the March 23rd panic low until that recent high, the S&P 500 was up 47%. So did we anticipate that? We definitely did not. But did we want to put our toe in the water and start buying some large cap stocks and a few other things? We did. So this has been a nice surprise. I think we're probably going to tread water for a little while, but this has been a nice bounce back in the second quarter.
And Scott, when you think about what the market has been pricing in, or I guess responding to, a version of an argument that I've heard quite a bit is that there's nothing negative we haven't thought about yet, right? I mean, every doomsday scenario seems to be on the table and in many ways assumed back in the spring. And so all of the surprises ended up being to the upside. As you look out for the next few months, does that balance of risks, as it were, seem more balanced, or does it still seem like everyone is well aware of all the downside risks and that we're still not appreciating potential upsides when it comes to whether it's employment, consumer spending, earnings, and so on?
Well, of course, on the downside, the negative scenario is we're all sitting at home in September and October, afraid to go out because we don't want to catch the virus. That's the worst case scenario. The market's certainly not anticipating that, but thinking about it. We've all heard about these virus cases, and in your last couple of segments, you guys have been talking about that. But as we look ahead, stocks right now, our year-end target is 3250 on the S&P 500, so we're a little bit below that. But we think we're going to spend some time consolidating. We've got this slight bias to the upside. But then when we look out through year-end 2021, which really we're trying to get our clients to focus on year-end 2021, we're looking for about 3,500. That's the midpoint of our target range for 18 months from now. So really, that's a nice appreciation in the market over that course of time. That's what we want our clients thinking about. We don't want them worrying about what's going to happen over the course of the next month or two. There'll be a lot of noise. There'll be a lot of uncertainty. But over the next 18 months, we think we have a good potential both in the economy and then in the stock market to move higher.
Yeah, and Scott, we've talked to a lot of folks who've said that it's really important to keep in mind the 18-month time frame, and it's certainly everyone says, "Oh, have a long-term time horizon," but actually sitting there and saying, "Okay, I'm going to not worry about 2020 earnings and maybe not even the first half of 2021." Are you getting positive responses from clients on that? Are they in agreement that it is fine to maybe sort of look through what we're likely to see over the next 3 to 6 quarters?
Well, that's always, Miles, that is very tough for most retail investors to do. And what typically happens is when you talk to these people in normal times, whatever normal time is now, they'll say, yes, my tolerance for risk is quite high, or at least I have a pretty good tolerance for risk. Then when you see some market moves like we saw over the course of the last 4 or 5 months, and you see these 1,000-point moves in the Dow and the S&P's up or down 50 points, they step back and they say, boy, I think my appetite for risk isn't quite what I thought it was. So this kind of market action, for the most part, it scares retail investors. I mean, when the market just keeps going up, everybody's happy. My phone doesn't ring too much. But when the market's as volatile as it has been, that's when my phone rings. And we talk about opportunities with clients and to take advantage when your forward look is good, as ours is economically. You want to take advantage of these pullbacks and these big down days and these big down weeks. But sometimes it's difficult for retail investors to step in. They have a plan, but they have trouble pulling the trigger on that plan when the opportunity presents itself.
All right, Scott Wren with the Wells Fargo Investment Institute. Always great to get your thoughts. Thanks so much for taking the time.
Thanks, Miles. Have a great afternoon.
Hey, investors. Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.